As we begin our conference, I would like to introduce our first speaker, Mr. Navin Ghorawat, Associate Director at BADRI. He will be sharing valuable insights on the insurance industry, offering a guide for investors. Please join me in welcoming him to the stage.
Good morning, everyone. Welcome to the conference. We'll start off with a brief mentee question first, just to see how many of these crowd members are repeat, and for how many of you is this the first time? So if you can just go to mentee.com or just use the QR code to scan. All right. I think we have a reasonable mix. I'm glad to see a lot of people, this is not their first time. They're revisiting us for the conference. So today we'll start off with UAE insurance industry. Usually when we look at it, we try to look at it from terms of just profitability, revenue growth, those sort of elements. But this time around, what I thought was it'll be interesting to see how would an investor take a look at it. The thought occurred because there's a lot of venture capital, private equity funds that are being set up within the UAE now. ADGM, DIFC are becoming hubs for capital investments coming in. So I thought it'll be interesting to see if I'm sitting at an investor's desk, does it make sense to look at the insurance industry as an investment opportunity? So first of all, a disclaimer, this analysis is purely an intellectual exercise. I'm not making any investment recommendations per se. So we start off by looking at profitability. An interesting thing that Ali also mentioned was that the insurance industry is fairly large within the UAE. It's about 60 companies. Out of them, about 25 to 27 are listed. But in terms of profitability, how does the profitability lie between different segments within the insurance industry? So I did an analysis purely for the listed insurance companies, and we see this is the trend that we observe for just the top 3 insurance companies in the listed sector. And we see it's an upward trend. They're making profits and consistently increasing profits. When you look at the rest of the market, not such a similar trend, so to say. We are seeing a trend that was flatlining, and then after COVID, when primarily the motor pricing wars that Ali was referring to started, a lot of profits sort of dwindled down. Part of this drop was also driven by lower investment returns. Now it has picked up back in 2024, which is just till Q3. But we still see that there's a gap. And how much is this gap? So if we take a look at as a factor of total profit from top 3 insurance companies divided by the total profit made by rest of the listed insurance companies, we see that this factor was in the range of 1.25, 1.3, and after the profit started declining, that factor sort of jumped up. It's come back down in 2024 as things have stabilized, motor rates have improved over the last few quarters after the discount circular was removed. But this is still an interesting factor that 3 companies are making enough profit. So the question that Ali was asking, is 60 the right number, or will the number be closer to 3 and then a few to add on to that to make the rest of the profits? That was net profits. When we look at underwriting profits, the picture is slightly different in the sense that 23 was not a profitable year for the top 3 companies either. This was losses that they had faced for different reasons, but underwriting profits, we don't see the same trend. which essentially, in other words, means that a lot of the profits for even the top 3 players were driven or compensated by investment income. But for the rest of the industry, the picture was a lot more grim. 23 overall made a loss. We'll see whether this was driven by the overall rest of the market or whether it was a few players that was driving this. The factors even more drastic in terms of underwriting performance. It's slightly in the region of 3.5 to 4. That's the underwriting profit that just 3 players are making compared to the rest of the market. So now we look at 24 Q3 YTD profitability for listed insurance companies again. The way to look at this graph is the bigger the circle, that's insurance revenue. How much are you writing on top line? On my x-axis, I have insurance service results or underwriting profit. And on my y-axis, I have investment results or rest of the elements that make up the profit. So ideally, all companies would want to be in the top right quadrant over here, which is the quadrant where you make profits on underwriting as well as on investments. And you definitely don't want to be in the bottom left corner. But what we see interestingly is the top 3 that we were referring to, the circles are fairly far out right and also far above the rest of the market. So what I did was to put things in perspective, I removed them from the graph and take a look at the rest of the market because it's a fairly large market when we take those out as well. Interestingly, there's a fairly 50-50 split between profitable companies and unprofitable companies when we look at insurance service results. Some companies are making underwriting profits, the rest of them are making underwriting loss. But from an investment perspective, a lot of the companies are making profit. There was only one company that's shown below the investment break-even point, which has booked a loss for the first 3 quarters of 2024. So a question that we've asked before, are we an investment industry or are we a underwriting or insurance industry? Coming to return on equity, which was the new element that we tried to analyze this year. So before we start on, I'd like to ask you as the audience, if you sort of go back to your phones, what do you think is the annualized return for the insurance industry, listed insurance industry in UAE over the last 10 or 11 years? The way we estimate return on equity for this purpose is purely your market capitalization and your profit. So profit divided by market capitalization every year. And then I sort of averaged it out. All right. Fairly interesting because although we were talking about the insurance industry as a whole, this is pretty much how the graph looks in terms of companies that are making more than 15%, companies that are making 10 to 15%, and companies that are making 5 to 10 and 0 to 5. But yeah, the right number when we average it out, just for context, is 9% over the last 11-year period. So the next question, what do you think S&P 500 made over the same period? Let's take a look. Okay, so interesting bit over here is that a large part of you think that S&P 500 beat the insurance industry as a whole. So as investors, you'd probably prefer S&P 500 and will be putting your own money in S&P 500, not in the insurance industry. It's partly true. The mean returns of S&P 500 over the last 10 years have been higher and have been in that ballpark 10 to 15% range. but only marginally better than the 9% that the insurance industry made. So this is the return on equity for the insurance companies that we analyzed. We see there's one line which is going fair above the rest of the lines. Part of it is also driven by the fact that some insurance companies don't actually have actively traded share prices within the market. So it's not really a fair approximation of their market capitalization and therefore the return on equity. So let's remove that outlier from the equation. And this is the performance on an annualized basis for the market. It's a fairly muddled performance, generally ranging between -10% to +20%. But it's not a consistent sort of trend when we are looking at the different companies. They're all sort of volatile movements. So a better approach, I think, to look at it might be if we club some of these companies together and take a look at the trend then. I'll skip this. So what I did is I did tiering, not from an insurance revenue perspective, how we generally look at companies that larger companies club together, medium-sized together, but I did it from a return on equity perspective. So I looked at the average return on equity over the period and then clubbed companies which were closer together in terms of return on equity provided. So tier 1 is the best performing mean return on equity, and tier 4 is the worst performing average return on equity. So, although still volatile, we can see that these graphs do make sense now. We can see that the dark blue line on top, which is the tier 1 companies, which are about 7 companies that we observed best in terms of return on equity performance, it's a fairly stable line compared to, say, tier 4, which are providing the least return on equity, which is a more volatile line. We can see that at the beginning, in 2013, tier 2 was actually giving more returns than tier 1, but over the period, it's fairly consistent that there's a consistent gap between tier 1 and tier 2, and broadly there's a consistent gap between tier 2 and tier 3 companies. Tier 4 is a bit more volatile. Now, because I asked you about S&P 500, how did S&P 500 perform? A lot more volatile. So this graph is a lot more zigzag, especially compared to some of the tiers that we looked at in the previous graph. If we compare it against tier 4, we can see that most of these companies made a loss at a large portion of this review period and probably beat the S&P benchmark when it was worst performing in 2018 and 2022. For rest of the periods, there's large gaps between the S&P returns versus the tier 4 companies' returns. Tier 3, better than tier 4. The gaps have reduced, but still beating the benchmark only probably twice or maybe thrice. Now, do tier 2 and tier 1 companies perform much better? Tier 2, fairly closer, but it still just beats the benchmark a couple of times. Tier 1, so now it appears that tier 1 companies are beating the benchmark by a lot more. At least the gaps when we see, for example, for 2022, the gap is much wider, similar for 2015. And it seems that it's a lot more stable compared to S&P 500 returns. So what I did was to paint a clearer picture, because that graph was good to look at a trend of how things are or how volatile things are. But another way to look at it would be that exactly how many times did the different tiers beat the S&P 500 benchmark and by how much. So a positive bar over here shows that tier 1 performance, tier 2 performance, etc. was better than S&P 500. And a negative bar shows that S&P 500 was better. So this is how tier 1 looks. It beat the benchmark 4 times out of 11. And when it did beat the benchmark, it beat it by quite a margin. Tier 2 only beat the benchmark twice in this review period by a smaller margin compared to tier 1 companies. Tier 3 beat the benchmark 3 times, but the margin that it beat the benchmark was a much smaller margin. But when it underperformed the benchmark, it's by a lot. And tier 4 companies, the underperformance we can see is massive, and the overperformance is fairly comparable to tier 3 companies. So at this point, the question that I would ask you as potential investors, or you might want to think that what would any other potential investors who's looking to invest within the UAE insurance industry would think. And I'll ask you, where would you invest your money? Whether it'll be S&P 500 or either of these tiers. And it's okay if you're not investing your money. We'll not hold you to the recommendations that you make. When we did a test run for this, there was a few cowboys who did suggest tier 4. I can see they're still there. All right. So more than half of the audience suggests that S&P 500 is a better bet. Then fairly obvious returns that tier 1, a fair chunk of you think that tier 1 is a good investment as well. And very small weightage for tier 2, 3, and 4. This is kind of expected, but as actuaries, our goal is to look at data in different ways and not just one way. And data can be pushed to give you the picture sometimes that you want to portray. So we were earlier looking at just the mean returns or mean return on equity. Now what I'd like to look at is what about volatility of those returns. We did look at the graph, that the graph of S&P 500 was a lot more volatile. But when I plot it over here where x-axis, the horizontal axis is mean returns, and the y-axis shows me the volatility of returns, each purple dot represents one company. And then I've color-coded the tier 1, 2, 3, 4 average returns versus the volatility. This is where the S&P 500 lies. If you're familiar, some of you might be familiar with efficient frontier for investments. So usually it is a curve, but even if you plot like a straight line to S&P 500, ideally, the more risk you're taking, the more return you would be expecting. So a company that's falling on right of this is performing fairly well in terms of the risk return that they're generating. And companies that are falling on the left are not generating sufficient return for the volatility that they have in returns. The thing that we saw for profitability is something similar that we're seeing over here as well. It's fairly an even split between half of the companies performing better and half of the companies performing worse on this straight line to S&P 500's return. Although half of you selected S&P 500, we'll see that tier 1 return is fairly close to S&P 500. The industry average was 9% that I initially mentioned, but tier 1 companies are returning fairly close to the S&P 500 return on equity, but with a much lower volatility. So sometimes those graphs where we were seeing S&P 500 is performing a lot better might be misleading because you're not looking at the volatility element of it in the right way. We see that tier 1 and tier 2 and tier 3 and tier 4 are not following this straight line upwards. It's instead sort of following a downward sloping line. And that downward sloping line is very different from what you would expect if you would ask an economist to draw the predicted values. Because you would have expected the companies to follow this upward sloping line, that companies who are performing better will have more volatility because they're taking more risk on board. Interestingly, fortunately or unfortunately, depending upon where you sit on this scale, this is not the case. So I revisit that question. Where would you invest your money? Can we take a look? Yeah. All right. Some movement. So from earlier, I think 58% that we observed for S&P 500, we now have 43. And few of you have jumped ship and moved to tier 1 and thinking insurance is a great business to be in now. But interesting thing to keep in mind, while this was somewhat expected after I showed the risk reward matrix, but the thing to keep in mind is a couple of things. One, that the risk reward matrix is just one way, again, to look at the data. There are other ways that you should be analyzing when you're looking at these as an investment. And second, that, so, sorry, switch to the presentation, please. Yeah. So the few key takeaways. What we looked at initially in terms of profitability, in the insurance industry, size does matter. When you're larger, you're making profits consistently on investments, consistently on underwriting. Secondly, there is more than one way to look at data. Whenever you get a set of data or results, always keep in mind that you need to question whether that's the right way to look at it or there are other ways to look at it. And lastly, especially when we look at the insurance industry, more risk does not always equate to more returns. We saw that the companies which were in tier 4 and providing the least return on equity had the most volatility or more risk in terms of return, whereas the companies that were providing the highest return on equity had the lowest volatility associated with it. That's my time. Thank you. I'm happy to take any questions if there are, but I will not be naming which companies fall in tier 1, 2, 3, 4. That's a more detailed analysis that we do.
I can give you that.
Yeah, go there. Sorry.
Thank you. So if you go back to slide 17, so on slide 17, you were showing how the tier 3, tier 4 performing against,
Yep.
sorry,
16.
16. Tier 3 and tier 4.
Yeah.
The implementation of regulations, the competition,
Yep.
credit cost digitalization. Don't you expect tier 3 and tier 4 to move further down?
So the thing with increase in regulation is that what would happen definitely is the cost of compliance for companies is going up. So if you're a smaller player, and again, just to clarify, doesn't mean that if you're tier 4, you're a small player. There could be a large company in tier 4. But if you're a smaller player, that cost will be more penalizing towards you. So although there's not a push similar to some other markets that companies grow in size or merge together within the UAE, but that cost of compliance is increasing. Over the last year or year and a half, we've seen a lot of new regulations come in, which do increase the cost of compliance of companies. And that will put a pressure on your fixed cost when you're operating in this market. Even though your marginal cost could fairly be similar because you're just issuing policy on a paper, but your fixed costs will get increased by that. So that will have an impact. Whether that transitions into eventually companies merging together within UAE as well, or whether there is more capital infusion. So again, if there is more capital infusion from an investor's perspective, does it make sense? That's something that we'll have to see. Yeah. Yeah.
When you're talking about tiering, tier 1, tier 2, tier 3, and tier 4, if I understand first before was just based on the metrics was return on investment?
Yes. Return on equity, basically.
Capital adequacy ratio
Yeah.
and all those things.
Yeah.
Okay. Now, normally global practices, the regulator, whatever you're suggesting from that, I'm not pointing you, but they discourage mergers of losing companies, regulators, which aim to maintain a healthy, competitive, and resilient insurance industry. That's what those things. Secondly, when we talk on point-wise, there will be a risk of contagion, if we talk about if we are going to do that. And then again, operational inefficiency will come in the market, which regulator will never look into.
Yeah.
policyholders' protection is very important.
Correct.
So they don't want two losers, three losers, four losers to combine and make it a group.
Yep.
That's such
Yep.
in that market. Because somebody has to handle a strong power.
Right.
Capital adequacy for that solvency, that's another concern.
Yep.
Challenges in integration with
Of course.
those companies. We can talk about market instability
Right.
that can happen. More or less hard, of course, in insurance, as people will say,
Yep.
it will happen. So better alternative should be, in my opinion, that what we do is restructuring, finding strong acquirers, or facilitating strategic partners with financial sound companies, rather than doing the clearing and grouping them
Yeah.
the way we have presented it. So that's
Right.
my question.
Right. Thank you. So I agree with most of the points that you made regarding combining. So the goal over here was not at all that the companies who are performing worse should combine and merge together. I was just trying to look at that graph, which was more detailed and more clumsy when I'm looking at 25 different lines, and try to club them together to see how the average of that portfolio performs. I completely agree. I think the regulator stance is fairly public in a lot of jurisdictions that two losing companies don't combine to make a winning one. And I completely agree with the issues that that might lead to. So I'll just take last question because I'm running out of time for the next one. Yeah.
First of all, thanks for all the analysis, quite good analysis. Did you have a chance to also look at how the UAE insurance industry stacks up against insurance industry in insure market?
So that's my next step because I was short on time. I only had 25 minutes to present. That's the goal that I wanted to do and compare it against different markets. But I think some of you I noticed meeting in the AM Best presentation that happened earlier as well. So they had done something similar. And interestingly, they had done it for reinsurance market, not the insurance market. And what they pointed out was that with the exception of the last 2 years perhaps, the reinsurance industry globally has been making single-digit returns as a whole. They looked at it different region-wise as well, and none of the regions were outshining the others. So that was interesting to look at. But yeah, for the insurance comparison, I have to do that, but that's the next step. Haven't done that yet. Right. Thank you, everyone.
Thank you, Naveen, for sharing valuable insights.